Nestle is the first. They make these things here. That's the Nespresso pods, but you'll see in a minute a whole lot of other things as well. Big Swiss company. Founded in 1866, it has a broad range and portfolio including waters and cereals and milk products, so we'll have a look at those as well. Market capitalization is huge. It's principally listed in the Swiss market, but there is also a dollar-based ADR, which stands for American Depository Receipt. What that means is there's a dollar-denominated security that people in the US can buy. $240.7 billion. So that's a big, big company. Price-to-earnings ratio, it's a little tricky. There's been some variability in recent numbers, but I'm seeing 27.8 there. That's fine. Dividend yield, I know, is correct based on historic numbers of around 2.97%. Let's put up the share chart immediately. You can see it's been a bit of a yo-yo, up, down, sideways performance in recent years. How do you feel about Nestle?
Yeah, this is, I love the share. It's one of my favorite shares, and the one reason for that is more a softer issue. You know, in South Africa, we know we struggle with unemployment, slow economic growth, and this has really been one of the few global companies that have put their money where their mouth is and have invested direct investment into the country. They recently spent about 1.2 billion rand into
That's building facilities and
building
production
facilities,
in South Africa.
yeah. 1.2 billion rand into expansion of their coffee factories. That was just last year, and they
Because
got
we must just point out, Nescafe is the one thing, right? So that's the Encore and the Nescafe Gold granulated things.
yeah.
But then they also own Ricoffee,
Yeah.
which is sort of like a coffee type product. I'm not sure if it's actually made from coffee beans. It's made from chicory, but that's a big product in this market.
It's a very big product, and I mean, just on Coffee, I wouldn't call it coffee. It's
There's an issue
that's
there.
another issue. But yeah, that's really what I like is they've put their money where their mouth is. They've spent big. They're saying over the next 5 years they want to spend about 3 billion. They've created 500 indirect jobs, and that's adding on an existing base of about 3,500 full-time employees. In terms of the investment case, why I love this company is it's very rare to find a company with a strong dividend growth, a high moat, and solid growth potential. We know that they want to grow organically. They aim to grow about 5 to 6% per year as a company.
The CEO's kind of stated plan.
Stated plan. For most parts, they've been able to achieve that, but more importantly is their dividend. They've consistently grown that over the last 10 years. And for me, when I'm looking at a share like this, that's actually what you're going for, is that dividend and looking at what sort of company in this. They have a huge or diversified portfolio of products, huge market share, and 25% of all their profits come from East Asia and South Africa. So we know that when we're talking about the growth story in terms of investments, we've
got the emerging markets,
you know,
Africa and Asia Pacific.
It hasn't really lived up to it, but that's
well,
still
let's
there.
talk about this though, because it does look great from a top-down perspective, and of course the coffee is a high-margin industry. You know, apart from the products here, this is a very powerful business with fantastic margins. There's dairy and related stuff, and other drinks and ice creams. There's water, a big part of the water business. You know, things like Nestle Pure Life, Perrier, Poland Spring in the US, San Pellegrini. So those are some pretty formidable type of presence, and water we know has got good margins. But the new CEO, Ulf Mark Schneider, is under pressure because he was kind of hired to try and awaken the slumbering beast. Because when you say they've targeted a 5% growth target, in the last couple of years they've sort of failed quite to get there. And there's always one excuse or another. So there's a lot of pressure on him to do something to jazz up the returns, which could possibly be to expand in some areas and contract in others. So to date, he's done no changes of great import, but quite a lot of the chattering analysts are saying that he needs to do something because they want to see higher capital returns.
I think the nice thing about his position is that he's not really forced to act, and it goes back to how we said how diversified the portfolio is. You know, a good example of that is last year they had to recall their Digonius pizza and some of their cuisine food because it was found to actually contain glass.
That's prepared foods.
The prepared foods, that you put in the microwave or oven. Was quite a big scandal for them, but yet it really had minimal impact in terms of their sales revenue, their profits, over the year. And then again, it just shows how healthy the company is,
It's like a Leviathan.
you know, it's actually it's a cash generating business. I think they're currently sitting on about 10 billion just in cash, looking for exactly that, where you're saying, what is the next step? What are we going to? But the luxury of being CEO of a company like this is you can afford to sort of
There's one
take your
final
time.
question I want to ask, is they do own about 23% of L'Oreal, which is a company we talk about quite often, which is obviously in the sort of skincare and shampoos arena. There's been some talk that maybe they want to grow bigger in that space. They do think, well, Schneider himself, I think, came from Fresenius or something, so he comes from a healthcare type background.
Okay.
I suppose that's a possibility. They could see that they do something with that stake, or they increase their investments in that area.
It's something. It's one of the stocks you touched on last time I was here, and that it's sort of it's a luxury good. And when you find if you do that business correctly, it's sort of recession proof, because like you're saying, you are marketing to your top 1% or high income earners. So if they do get it right, definitely. And you sort of need to diversify, but also choose your market carefully, because there isn't a lot of growth out there. There's not a lot of cash.
Let's go back to that share chart and while we have the conversation about hot or not. So my sense is, look, I own some of these personally in another portfolio, not the hot stocks portfolio. It's been quite a long wait. They've been in this band, this OTC NSRGY, that's the ADR in the US, has been around $70, between $70 and $80 since for, I don't know, as long as I can remember. But it sounds like you're hot on them. You think it's a company that can do things.
I'm hot. I love the company. I hold the shares, and yeah, I think it's a fantastic company. Especially, it's sort of one of those recession-proof companies. And when you're in a slow economic growth, or there's so much volatility in the market, you look for companies like this. Yeah.
And as you say, it's got the optionality with its cash on hand and its portfolio and the management team to perhaps break out of the mold. Okay, good. So we'll go hot on that one.